It's been an interesting few weeks, full of economic news, which has led to a lot of uncertainty about the future of our economy and our property markets. Now, if you're a regular listener, you'd know once a month I catch up with leading economic commentator Pete Wargent for these big picture podcasts. And we look at the macro factors affecting our economy and our property markets. And boy, have we got a lot to discuss today. Interestingly, only a couple of minutes after we recorded this show, the Queensland Government did a backflip and it repealed its outrageous land tax grab. So even though we spent a couple of minutes talking about it in today's show, this tax is no longer a concern. However, the underlying tendency for governments to see property investors as an ATM that they can just milk when they want to, well, that hasn't really gone away, has it? And in other good news, Governor Philip Lowe is easing his foot off the economic brake, and he's actually taking time to assess the impact of the most aggressive monetary policy tightening since the early 1990s. By now you know the Reserve Bank sensibly dropped back to a 0.25% interest rate hike at its October meeting. Now, while it's likely we're going to have another 1 or 2 0.25% rate hikes, it looks like the peak of interest rates might be in sight. And in today's show, you're going to hear Pete Wargent and me give you our thoughts on what that means for the property markets. I also chat with Pete about the latest US inflation figures and the interest rate hikes over there, which have spooked the markets because there's no sign that underlying inflation is abating in the United States, and in fact the probability of a recession there is increasing. You might also remember that the Reserve Bank Governor Philip Lowe warned that this deteriorating global economic circumstances would make it hard for Australia to achieve a soft landing due to the economic buffeting, in his words, that's underway. At the same time, Philip Lowe said he wouldn't be surprised if house prices fell 10% from their peak. But then only a day later, Jonathan Kearns, head of domestic markets of the Reserve Bank, suggested they could even fall 15%. Well, I don't necessarily agree with him, and I'm going to explain why in today's show. Now, clearly you enjoy these big picture podcasts, as they're the most downloaded of my regular podcasts, and I'm sure my chat with Pete today about inflation, about employment, about interest rates and China's property market will give you some great insights. So welcome to today's show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Boy, has a lot happened since I last spoke with Pete Wargent for our monthly Big Picture podcast. Now, in recent weeks, predictions on the course of Australia's house prices have been coming in thick and fast from all quarters. Even the Reserve Bank Governor Philip Lowe threw his hat in the ring, predicting a 10% fall. But overall, the predictions have fallen anywhere between 10%, 25%, 30%. If these forecasts came true at a national level, which is what people are predicting, they'd be the largest in the 41 years of modern history of keeping records of the Australian property market. So today, amongst many other topics, I'd like to have a chat with leading analyst Pete Wargent about the economic challenges overseas and what they've made several commentators say, how various people have changed their minds about what's ahead. Now, while regular listeners will know Pete well, if you're new to this podcast, well, firstly, welcome, because I can see that we're getting lots and lots, thousands of new listeners every month. But the reason I'm keen to discuss these matters with Pete Wargent is not because of his academic credentials as a chartered accountant, a chartered secretary, or because he's got a financial planning diploma, but I enjoy these chats because of the credible perspective Pete brings on what's happening around the world, because he's an international investor and business person. So, after that long introduction, welcome, Pete.
Thanks, Michael. I always look forward to the Big Picture podcast, and especially this month because I'm with you down in Melbourne as well.
Yeah, well, we caught up face-to-face a few times. We're not face-to-face at the moment. Even for the grand final, you came down to see how Victorians celebrate. It wasn't much of a celebration, was it?
Well, not for the Sydney Swans, but let's gloss over the result.
Okay. So, look, there's lots of negative news out there at the moment, but I'd like to start our chat today with positive news. Now, it may not feel that way, Pete, but Australians are the richest people in the world? Well, that's according to Credit Suisse. Now, we know that it's really soaring house prices and other assets that have raised the number of Australians who can consider themselves millionaires. Apparently, there's 2.2 million millionaires in Australia. And when looking at the median net worth, it actually shows that the worth is pretty well evenly spread, and we're wealthier than every other country, Pete.
Yes, so I think it's first worth making the observation that when Credit Suisse started doing these reports, $1 million US was considered wealthy. But I think when you look at it today, realistically, a better measure of wealthy is 5 million US or above. Credit Suisse actually acknowledges this in its report, and it breaks it down as a wealth pyramid. Now, look, everybody loves to hate this Credit Suisse report, and it's partly for good reason, because wealth is very often tied up in superannuation or in housing, and that's partly true. But despite this, there is something in it. Credit Suisse noted way back in 2011 Australia's stellar performance through the mining boom, and then in later years they said we were resilient, and then in later years we're still resilient. And now, as you mentioned, from a median wealth per adult perspective, Australia is top of the tree. So that does mean something. Now, if you look at, say, Switzerland, they've got a whole raft of multi-billionaires and a different tax system. So they'll probably always have a higher mean wealth per adult. And the US is obviously also a powerhouse from an average wealth perspective. But I guess it does show, since the end of the mining boom, we've had the financial crisis, the Banking Royal Commission, and then COVID. And despite all of that, Australia's risen to become the wealthiest country per capita on the median measure in the world. So yes, we'll have a pullback next year because the stock market's down and house prices in Sydney are down a bit. Also because the Aussie dollar is lower, that has an impact. But overall, what a country to live in and what a position to be in.
Well, one of the statistics they come up with is how many high net worth individuals there are. And I remember at the end of last year, they showed that there were, in our big population, there are 220,000 high net worth individuals. And that basically means somebody who's got their own home plus $1 million worth of investable assets. Pete, that's not much at all, is it?
No, and I think that's why Credit Suisse now, they show there's a list of sort of millionaires, but they also look at significantly wealthy people, which is 5 million US and above. And then they even have a category for super wealthy, which is getting up to the 100 million US and above. But there's not actually that many of those in Australia. A few billionaires cropping up on the list. But it's actually just it's the median wealth in Australia that's so impressive. And as you mentioned, over 2 million people now with a net worth of above 1 million US.
Now, having said that, people keep talking about how much debt we've taken on. But if you look at the net asset position, and every month the Reserve Bank shows that in their statistics, while wealth has gone up because we've got assets, because our houses have gone up, because our superannuation has gone up, and debt has gone up a bit, it hasn't gone up in the same proportion. So our net wealth of average Australian is actually higher than it was before. We're not in a bad position.
No, so household wealth went up to around, 15 trillion or so, absolutely huge increases over the past dozen years or so. I think the leverage does make a difference. It makes a difference to Australians' ability to create wealth, especially through housing. But it also has an impact on monetary policy, as we'll come on to shortly, no doubt.
Well, okay, let's talk about that, because since we last spoke, and we all felt a little bit positive about the future, the global signs aren't as good. The outlook for house prices and shares worsened over the last couple of weeks because interest rate expectations increased. In other words, it was on the back of the economic data that inflation isn't really coming under control, that the US is probably going to go into recession, that Britain is possibly going to, that part of the European Union is going to as well. The inflation figures just don't seem to be coming under control with rising interest rates. So the thought is interest rates around the world are going to have to keep going up, Pete.
Yeah, so I guess a useful analogy is to think of a pendulum. And if you think back to 2020 and 2021, I mean, the pendulum had swung so far in one direction. Everybody was on that side of the boat. People thought interest rates would be low or even negative forever. Now the pendulum swung the other way. and a lot of pundits can only see interest rates going up. Now, to my mind, the whole point of the Big Picture podcast is to keep us focused on that big picture, and it's an antidote to the day-to-day noise of market reporting. So yes, interest rates will go up, but eventually they'll move into contractionary territory and interest rates will come back down. So look, I don't really like the phrase narrow path, but in a sense, that's what the Reserve Bank in Australia has to do. It needs to show commitment to bringing inflation back down to target at 2 to 3%. So it's got to talk tough and increase interest rates over the next few months. And we can't be too slow to do that, because if we're too gun shy, then the Aussie dollar will fall because the Fed is raising interest rates in the US, and we could import some inflation that way. But on the other hand, I think you can already see that the cash rate increases to date have been a bit contractionary. You can see the drop off in things like building approvals. We don't want to go so high that we end up causing a recession. So that's the balancing act to be pulled off.
Well, I guess one of the questions is, are interest rates actually working in the rising interest rates? In my mind, the Reserve Bank, Philip Lowe and the Reserve Bank have got two important tasks. Yes, we've got to lower inflation to make it easier to live in Australia, but not send us into recession. And while we are borrowing less on the big items, as you said, because it's harder to borrow against your home, it doesn't seem to be working too well at the retail level yet, does it?
No, I think there's a lag. I think rising interest rates are having an impact on consumer confidence, and so will rising consumer prices, of course. But it does take time for these impacts to flow through. If you look at things like building approvals, they've collapsed to about 13,500 last month. Well, they were running at over 20,000 per month on average for about 6 months in 2020 and 2021. So it all takes a bit of time, and you'll see the things like the price of building materials and freight and commodities, they'll all be on the way back down. And of course, house prices themselves, as you already mentioned, we have seen some significant drops just at the very top end of the market in Sydney. So places like Bronte and Clovelly and Vaucluse. And I guess those markets are a bit more volatile, maybe a bit more, thinner markets, and they're more leveraged and a bit more of a speculative component. Maybe more impacted by things like banker bonuses, but not really seeing it so much in the middle market in cities like Melbourne. Some areas, bit of a stock shortage even, and in some areas prices are even rising, like if you've got a unit in Brisbane, for example.
Sure. So there isn't one property market. And so when there are those discussions about a 10, 15, 20, even 30% fall of the Australian property market, well, there isn't one, and there are markets within markets, as you say. So currently it seems, when you're looking at auction clearance rates and how quickly it's taking to sell good A-grade properties, the market hasn't found a floor yet, but it seems to be looking for one, isn't it? Auction clearance rates are holding and good properties are still selling, and vendors aren't having to give them away.
No, I think if you look at the number of properties for sale, one of the characteristics of the last couple of years, there was record low levels of stock. Now, there have been some increases in some areas, but actually the number of property listings to date, anyway, haven't increased that much. I did also see some analysis by our good friend Michael Matusik in one of his market missives, and I think it showed the price of delivering the higher density stock is up by it's nearly 60% in the last 3 years. And I'm sure you've seen with your development team, the price of construction and development has increased quite significantly. I've talked to people where contracts are up 50% over a couple of years. So I think that's going to underpin the prices of new dwellings, and certainly sort of the middle and lower segments of the market. We haven't really seen significant price declines that much.
Now, that's a really good point, because currently there is a shortage of properties. We know there's a shortage of properties in the rental market, and there's not many good houses for sale. And if we're going to increase our population by 200,000 or so, as the government's suggesting, we're going to have to provide a lot of new accommodation, but it's just not there, and it's not financially viable to build the new apartment complexes, even the new houses and the new estates, because it's going to cost more than the market's prepared to bear at present. So the new development's not going to happen until property values go up. But that's what happens at every stage in this, every cycle of the slump stages we're currently having. So new properties are going to cost more. That's going to drag up the value of established properties. And the other thing we're noticing at the moment, Pete, is that apartments aren't falling as much as houses, because while there was a trend away from them over COVID, people are now trading space for place. They're wanting to be in the right neighbourhood, so they're happy to move back to apartments, villa units and townhouses, not in the high-rise towers, but in those more established sort of older blocks that we used to call flats.
Yes, it's almost like a reversal of that race for space that we saw through the pandemic. And as you said, I think unit prices over the past decade have underperformed house prices, and now it's been less volatile, less on the way up and less on the way down. I think the thing is, as you've already touched on, the ALP has just launched the biggest immigration program in Australia's history. I mean, that's going to add a huge amount to, well, firstly, to the labour supply over the next few years, which is what we need. I guess that will put some downward pressure on wages. But I think the thing is, if you look at that, Australia's population is going to increase by, 1 million people, from 26 to 27 million over the next 2 to 3 years or so. So it's pretty hard to have the economy going backwards with that kind of tailwind. But it's really the demand for housing is the interesting part. We've got rental listings are at record lows. We've got, the immigration cap has been increased. We've got the reversal now. There's a huge drop in the number of temporary visa holders in Australia through the pandemic, about 600,000 or something. Well, that's now rebounding very quickly. We saw just on the last monthly figures, 100,000 people in a month. I don't know, we'll see that sustained, but it just shows the sheer weight of demand for housing over the next 2 or 3 years is going to be massive.
At the same time, there's going to be a lot of jobs created. I see leading demographer Bernard Salt suggesting we're going to create 1 million jobs over the next 5 years. Now, that sort of fits in with the requirement of having 200,000 skilled migrants or workers coming out of our TAFEs and our universities. So that's going to underpin our economy as well. So while there is the possibility of us falling into recession, even recently the International Monetary Fund, but the Reserve Bank's forecasts are suggesting slower economic growth. I mean, that's what they want to do, but no recession. And even, Pete, in my mind, if it is a technical recession, in other words, growth goes backwards for 2 quarters, as long as people have got their jobs, it's really a technical thing rather than affecting people's livelihoods. Yeah,
I don't think Australia will have a recession. America might. I think if you look at market measures and expectations, but it's a different dynamic. It's in America, you've got most Americans are on 30-year fixed rate mortgages, whereas in Australia, most of us have variable rates or short-term fixed rates. So now we, as we already mentioned, have more household debt in Australia, but those two factors do actually make Aussie households more sensitive to changes in interest rates. So while the Fed is in a bit of a panic and probably now committing a policy error by hiking up rates very, very quickly, I think they've been a bit humiliated by the surge in inflation there. Now they're overcorrecting. So we don't really have the same problems in Australia. We don't have very strong wage growth. There's no risk of a wage price spiral. And I think the Reserve Bank even previously said they would like to see wages at 3.5%. We're miles below that at the moment. So the Reserve Bank will increase interest rates over the next 2 or 3 months. But I don't think we need to see the sort of wild pace of increases that some other parts of the world have seen. And also we've got, as I mentioned, 1 million people extra in the economy over the next 2 to 3 years. So I think while the US might be at risk of recession, I think in Australia we needn't have one.
Well, you've mentioned a few times the US. There's another country that's creating a bit of concern for the Reserve Bank. The Reserve Bank's been out busy telling us what they think lately, and even saying what they think is going to happen to property prices. Philip Lowe said he's not forecasting, but when he said the property market could drop 10%, all else being equal, the media jumped on that. But his assistant, Michelle Bullock, confirmed that there are 2 big concerns with China, Pete. First of all is their zero COVID policy, which is creating ongoing lockdowns and restricting their economy. And the other is their property market crash, which I guess being a different economy, not a capitalist economy, they've got more ways of controlling things like that.
I mean, China is likely to be stepping on the accelerator in terms of stimulus and easing policy rates. I think an interesting thing in China is that earlier than expected, the population of China is now actually in decline. Some of the tailwind that has been behind China is it's slowing anyway. Despite that, I think urbanization is still going to continue in China over the next decade. So that's still okay for Australia's exports. The things like the coal and the iron ore, copper and gas and so on. But I think there has been a shift in the relationship between China and Australia since the days of Kevin Rudd. And I think what we're starting to see is that migration into this country and tourism is shifting away from sort of Chinese arrivals and more towards other countries, in particular India. You can see that in the international students figures. So I think, as you said, China will have its own ways of dealing with the slowdown. Got big reserves that they can tip into the economy. But I think for Australia, there's a bigger picture question there. We used to have a lot of Chinese investors funding our new apartments and booming tourism. That's not really happening so much anymore.
And the education sector too, Pete.
Yes, you're right. And the international students mix is changing too. So, look, I mean, there's no shortage of demand for people wanting to come to Australia, but it's not all being driven by China now.
And maybe that's not a bad thing. Now, Pete, I love listening to your weekly podcast and I read your blogs every day, and we'll be telling people how to get that shortly. But you've been in the media a lot lately, Peter, with your suggestions about Queensland needing to repeal its land tax before the rental markets implode. Do you want to share with us what your thoughts are there?
Yes, I mean, it's a very unusual situation. If you're not familiar, Queensland is proposing to assess land tax for investors based on properties held all around the country, not just the properties in the state of Queensland itself. Now, there's a whole range of questions that come out of that. For one, how will it even be enforceable if they don't have access to the records of other states? What happens if other states go down the same route? But the main problem at the moment is there's a rental crisis already in southeast Queensland. The Premier was discussing the use of prefabs, maybe converting old student units, allowing people to use granny flats. It's an absolute quagmire already. The last thing the market needs at the moment is a new tax, which will discourage interstate investment. It will have an impact on the residential market, on the commercial market. Some investors are already choosing to sell up their properties.
Well, it's actually not new investors coming. You're 100% right, Pete. We know that the Property Investment Professionals Association did a survey and they found that 16.7% of investors had already sold up at least one property in the last 2 years. And the main reason they were selling up is the new land tax legislation, also the residential tenancy legislation. They're feeling they've not got control of their financial future, have they?
No, we've seen similar complaints in the ACT about the balance of power between landlord and tenant shifting in one direction over recent years. I think the problem for southeast Queensland is you've got a net interstate migration at an all-time high, 54,000. So a lot of people moving because of flexible working arrangements, seeking out sort of better lifestyle and affordability. So that's 54,000 reasons why the rental crisis is only going to get worse. Because if you've got investors looking elsewhere, who's going to supply the rental stock? It's really not been thought through. I've had plenty of pushback on social media from people saying it will all work out fine, but the early signs aren't good.
Well, it's a combination of things. Current investors are selling up. New investors are wondering, should I buy in Queensland? Maybe I'll just avoid Queensland altogether. And when they are selling up, it's been suggested anecdotally, but also this was now backed up by Pippa's survey, that in general, the people buying the properties are owner-occupiers or first-home buyers, so it's taking even more property out of the rental pool, while others, with what's happening at the moment with travel in Queensland, are putting them into Airbnb, so even fewer properties are in the rental pool.
Yeah, so that seems to be a bit of a global trend at the moment. More short stay lets and use of portals like Airbnb. So, look, it's a nationwide issue for Australia at the moment, but Queensland is bringing it sort of further challenges upon itself by an ill thought through tax. So, yeah, we'll have to see how that plays out over the next couple of years.
Now, just to make it clear, it has been legislated. It is coming in. Of course, they can repeal it as they've repealed taxes, and the federal government and state governments have repealed taxes before. But I think that they haven't understood the unintended consequences. In fact, they've only suggested it's going to bring in $20 million worth of taxes. So I can't see how the fallout's going to not overwhelm the extra small amount of tax they're going to get. But part of why we have these chats is to take people back to the macro level and to the big picture. And one of the benefits of paying land tax, if you can say that, is that at least it's tax deductible. And if you get proper advice, there's nothing you can do about properties you currently own, but there are ways of structuring yourself to make sure that you don't get this double land tax. And that's not you and me giving advice at the moment, but suggesting people get advice before structuring. So I think Queensland's got great opportunities, and if everyone else is jumping out of the market, it's going to leave it even stronger for those who stay in as investors. But boy, I wouldn't want to be a tenant in Queensland.
No, there's not much on the market in certain parts of the Sunshine Coast, Gold Coast, parts of Brisbane, and it's only getting worse. And I think your point is a good one. If you're an investor, it's not the end of the world, but you just need to think a bit more carefully about structuring and get some good advice.
Sure. Now, of course, because your costs go up, whether it's your mortgage or your land tax, you can't necessarily put up your rents. We know as investors over the last few years, it was very difficult to put up rents. The only way you can do that is when there's a shortage of rental properties, which is currently happening. So there will be an opportunity for rents to go up. You can't do it straight away. There are conditions of how often you can do it. But there's no doubt that the end result of this is rents are going to go up. So the tenants who, in many ways, the government with its residential tenancy legislation are trying to protect are the ones who are going to suffer the most.
Yeah, if you look at the official inflation figures for rent, at the moment they're not showing much growth. But I think the thing is, if you've got to look at the sort of forward-looking indicators. SQM Research do an asking rents index, and I mean that's up by over 20% per annum. CoreLogic is in double digits. So I think you can see that it takes a bit of time to flow through, but yeah, rents are definitely going to be rising pretty sharply. Certainly for investment grade properties. It might not be every property on the market though.
So what's the next change they're going to do for legislation? Well, the Greens have come up with the concept of a rental freeze. Now, I know that's happened in Scotland. It's happened in New York at times in the past. I know the Albanese government said, no, we're not going to do that. But everyone seems to be picking on property investors, Pete. Is it time to get out of the market?
Well, no, I think
That's a rhetorical question. Of course it's not.
Yes. I mean, things like rental freezes, we've seen over and over again over the years, price caps don't work. I mean, we've seen in recent years in Ireland, they've gone down this route of trying to curb greedy landlords, and now they've gone full headlong into a rental crisis because there's just no rental stock available. Queues going down the street in Dublin. Look, the Green Party has made some suggestions about rental freezes. It's a terrible idea. Nobody caps rents when they're falling. You shouldn't be doing it on the way up either. Look, I think a really simple fix to begin with would be to allow investors to borrow again. The regulators put in place a lending assessment buffer of 300 basis points. Well, that made sense when the cash rate was at zero and when there was a borrowing binge. But now we could probably remove that and go back towards the historical norms of allowing investors to borrow with a reasonable stress test.
So just to make it clear for those who don't understand, whatever interest rates are at the moment, APRA have made the banks assess your borrowing capacity based on the fact that you could borrow if interest rates went up 3%. And as Pete said, that made a lot of sense. But interest rates have gone up 2 and a bit percent, and they're going to go up probably 3% overall. So it was the right thing to do then. But we don't want to expect interest rates to go 3% more than they are now. So lowering that buffer would ease the borrowing capacity, allow people to borrow more, and I guess grease the wheels of industry. So I think as we keep talking about this being a big picture podcast, we've got to remember that this is just another stage of the property cycle that we've been through before. The booming markets that we had the last couple of years were unsustainable. Now property values are falling in some areas. They'll keep falling in certain areas. They'll languish in other areas. And eventually, when interest rates reach their peak, or when the market assumes they have, and when inflation seems to be under control, the pent-up demand of people sitting on the sidelines, in my mind, Pete, is going to now get back into the market because people are going to get on with their lives. So it's not that there's going to necessarily be lots more affordability, that people are going to make property values boom. So I think as the market moves on, prices will steady, they'll stabilise for a while, and then they'll gently go up, driven by demand. And in fact, that demand is going to come from people with higher paying jobs, while the poorer people, and it's not a judge of people, but they're going to be more hurt by rising rents, rising inflation, wages not going up as much. So we're going to end up with a much more fragmented market moving forward.
I guess summarising in my head here what we've discussed, I think there's three key messages there. Firstly, yes, housing prices overall are coming off the highs, but the economy has been incredibly strong. It's actually been too strong. We've got 50-year lows in unemployment. We need to cool it down a bit. So the second point is, yes, interest rates will rise, but they will peak eventually and they will decline again. And I think the third thing, as you mentioned, population growth. I mean, population is probably going to increase by 1 million people over the next 2 or 3 years. It's a huge demand for housing. Now, I'm quite sort of fond of saying, before the GFC, we had a cash rate of over 7%. But actually, when you look back at it, it was over 7% for 2 or 3 months. And then it fell all the way to 1.5%. Same with the baby booming generation. You hear a lot of people say, we had a cash rate of 17%, but actually by the end of that
1
year,
or 2 months, I think.
Yeah, that's right. By the end of 1990, it was 12%, and then the cash rate kept on falling to under 5%. I think a lot of people getting very obsessed with, where's the terminal rate for this cycle going to be? But the reality is the interest rates will go up and then they'll come back down again. On average, over the next decade, they won't be at absurdly high levels.
Well, as always, I have fun chatting with you, but I'm going to encourage people who've listened to this to get more of the great information you give. So firstly, I enjoy your podcast. And if you're interested in following Pete, wherever you're listening to this podcast, you're going to find his as well, Pete's Property Podcast, and you've got a great range of guests. One of the reasons I enjoyed is because you have different people to the other general property podcasts who bring a wide range of different ideas. So follow Pete on his podcast. And if they want to follow your daily blog, Pete, where do they find out about you?
Easiest place to find me, Pete Wargent Blogspot, or if you're game, I'm fairly active on social media at Twitter.
Fairly active, that's an understatement. Yeah, follow Pete on Twitter. No, I really do recommend it because you actually retweet a lot of other people's ideas as well. So it's not just yours. So you're a great curator of news.
Yes, that's a nice way of putting it. I do waste too much time on that website, but my Twitter handle is @PeteWargent, so you can catch me there too.
Fantastic. Look forward to catching up with you again in about a month for this Big Picture podcast. Thanks, Pete.
Pleasure. Thanks, Michael.
As you heard in my chat with Pete, there's so much uncertainty at the moment. And that's creating, in my mind, a window of opportunity because at the moment, with consumer confidence being low, people are sitting on the sidelines. We discussed all the factors affecting the property markets a couple of moments ago, but the big one that I think puts it all together is consumer sentiment. That plays a big role in the performance of our housing markets. Well, in the short term it does. And when consumer sentiment's low, potential property purchasers, whether they're home buyers or investors, they sit on the sidelines, and that's showing up at the moment in our property markets. However, as Pete and I suggested, in due course and probably sooner rather than many people expect, we believe the market's going to shift, sentiment's going to shift as people recognise that interest rates aren't going to go any higher, as they recognise the Reserve Bank's controlled inflation is coming under control. And that's probably going to happen in the first or second quarter of next year. And so, in my mind, that creates a window of opportunity for people with long-term goals. Now, I'm not suggesting trying to time the market. What I am saying is when consumer sentiment's low, but the rest of the economic fundamentals are in general sound, this creates an opportunity. Sure, the Reserve Bank's hell-bent on slowing our economy, but overall, the economy, even though it's going to slow, is going to remain strong. We're not going to go into recession. The housing markets are basically sound with a very low loan-to-value ratio overall. Core logic, and also the Australian Bureau of Statistics suggests there's about $9.7 trillion worth of residential real estate in Australia, with only about a 22-23% loan-to-value ratio of 2.1 trillion debt against this. So sure, some people have overcommitted, but in general, our housing markets are in good shape and mortgage delinquencies are low. Most mortgage holders are well ahead in their payments because they kept their regular repayments over the last few years when interest rates fell and households are cashed up, unemployment is low, and there's a rental crisis. And once immigration picks up, that rental crisis is only going to worsen, and the severe shortage of properties isn't going to change anytime soon. There's no risk of oversupply as we're not building enough accommodation, and we can't because financially it doesn't stack up. It won't until prices increase again, until the cycle moves on. So my suggestion is don't allow this window of opportunity to pass you by. Why not have a chat with my team at Metropole to see what your circumstances are? Have a complimentary clarity consultation with one of our property strategists. Go to metropole.com.au. It would be a shame to miss this window of opportunity. Now, I don't know your personal circumstances, and we'll let you know if it's not right for you. But if it is, as I said, it would be a shame to miss out. So go to metropole.com.au.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
Today, in my mindset message, I'd like to talk to you about ways to improve your life satisfaction. And I got the concept for today's chat from a blog I read from Rob Dix, who interestingly runs a British property podcast. And I was interested to read that he said that happiness is the art of wanting what you already have. Isn't that interesting? Let me repeat that. I think it's worth it. Happiness is the art of wanting what you already have. Now, somehow without trying, I think I've actually got this attitude. I'm happy with my life. When I'm at home in Melbourne, I'm happy here in Melbourne. When Pam and I travel overseas, not that we've done it this year, when we're travelling, I never want to come back. I'm happy with that. I'm happy with the food I've chosen at the restaurants. I think it's actually quite good. I don't actually say, oh, gee, that meal over there looks good. I don't want to swap my problems for somebody other problems when things go wrong either. In other words, the grass is always greener on my side of the fence than it is on the other side of the fence. And that's good. I'm happy pretty much of the time, and I don't really experience any sort of jealousy. Now, I know you could be saying, well, that's easy for you, Michael, because you've been lucky or you've achieved a lot and you're wealthy, and you're entirely right. But I also know plenty of extremely unhappy people with great material wealth and what others would consider wonderful lives. So I believe this wanting what you have attitude can be practiced whatever your current situation. So how do you do this? Well, I think the first thing you should do is practice noticing what's great about what you've got. You see, our mind has evolved to notice what's not good about our current situation, and that's on purpose to help us strive to improve. I think about it, if our ancestors sat around being thrilled that they had one bucket of grain to last them through the whole winter, none of us would be here today. So we unconsciously go through our day noticing that our house is too small, our children are being difficult, our job is dreary. So to counter this, my suggestion is to develop the habit of noticing what's great about what you've got. Your house is situated in a great suburb. Your kids are spirited. They're inquisitive. Your job has got great potential, and you've got the ability to then go home after your job and enjoy your life. So at the start, this is something you've sort of got to consciously force yourself to do. And I learned this technique many, many years ago. So every morning when I get up, I think of a list of things that I'm grateful for. I do that every day. And it's usually about 5 things. And it's got to be different from the day before. Otherwise, you sort of cheat, don't you? Over time, though, this becomes a habit, crowding out the habit of noticing what you're not happy with. The second way to be more happy with what you've got in your life at the moment is to speculate about what's bad in somebody else's situation. Now, again, a natural instinct, and that's particularly more obvious today in the days of social media, is to look at somebody else's possessions or situations or jobs and want that for ourselves. It's difficult to want what we have, to be happy with what we've got when we're busy wanting what somebody else has got. So I'm going to suggest you try the habit of reverse jealousy. Go out of your way to point out what might not be so good about somebody else's situation. Wow, the logistics of staffing that business with 60, 80 employees and all the hassles that come with that must be a nightmare. Oh, look, that kid, he may be really good at sport, but he actually doesn't have much of a social life because every weekend he's got to be training. Oh, he must be constantly worried about his beautiful new Lamborghini car that people are going to scratch it if he takes it out in public. So now, long term, this isn't healthy. I'm not suggesting that you shouldn't be happy for other people's success. In fact, that's one of the traits of successful people, that they're happy when other people are successful. But I'm suggesting this more as a deprogramming exercise to kickstart your own satisfaction, flipping your potential jealousy for other people, noticing, hey, what's not so good about it? Because remember, we tend to see our problems in more detail than others. There's no such thing as a perfect marriage, a perfect business, a perfect job, a perfect house, a fantastic property portfolio, perfect health, or a perfect anything, really. We've all got worries, insecurities, frustrations, niggles, aches and pains, and there's a myriad of ways. Everyone's life is far from perfect. It's just when you've got a front row seat for these imperfections in your own life and you only see others fleetingly or from a distance, this magnifies what you see as your own problems. And of course, as I said a moment ago, social media, where people go out of their way to present a very filtered, staged, managed image of what their perfect life is, that makes it hard for us to compare what's going on with our life. So it's important to remind yourself of this frequently until you internalise it, that, hey, that's not the real world. Reality TV isn't real either. Otherwise, you can never be happy with what you've got because you're never going to live up to that illusionary perception of what other people have got. Now, another thing you should do is balance happiness with a drive to improve and progress. Like I said, persistent dissatisfaction is a powerful motivator. So if you become too satisfied with your lot in life, it may end up losing your drive. So I suggest you really got to balance the two. When it comes to your possessions and your family and your standing in life, you should want what you have, making sure you keep harmful envy at bay and appreciate the small moments that you have each day. And a lot of us who've had to stay home, be more locked up through COVID, have suddenly learned to appreciate different things, haven't they? But it's also okay to be dissatisfied with your professional progress or your sporting prowess or your ability to understand a particular problem or subject or your station in life. You want to get better and you want to not compare with other people, but you want to do better for yourself. So as long as it doesn't become an obsession and sits within the framework of your overall life happiness, wanting more than you've currently got is actually a good, useful, powerful motivator. Well, I hope you got some benefit from my chat today. Now, if you did, and you know somebody else who'd also benefit, do them a favour. Tell them about the Michael Yardney podcast. All podcast apps have a share button. On Apple Podcast, there's 3 little buttons at the bottom. You just press them and you'll get the share button. Or tell the world by leaving a review. Now, I've got a way of saying thank you for listening to my podcast. Go to podcastbonus.com.au and you can pick up a heap of reports and ebooks to help you become a better property investor. I'll be back again real soon, but you can follow me on social media. Just look for Michael Yardney, or why not join my private Facebook group where every day I leave some little tidbit I don't leave elsewhere. Go to Facebook and look for the Property Update Facebook group. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?